Welcome back to the Cash Flow Show. I am your host, Christian Carrillo. Today we've got a special interview for you folks, and one that I'm super excited for. Our guest is Heather Dreves. Heather, thank you so much for being on the show. We're so excited to have you with us.
Yeah, thank you. I'm excited as well.
Awesome. Well, Heather is the Director of Funding at Secured Investment Corp and Fund Manager with one of the fastest growing companies in the private money marketplace in the US, focusing on residential real estate investments. Heather is passionate about helping self-employed entrepreneurs and their families build wealth and succeed in their business ventures, and also helping investors deploy capital that is looking for a high yield passive investment backed by residential real estate. She has seen real estate investors succeed and fail, and is committed to tipping the scale to the side of success for everyone she can. Heather, again, we're super excited to have you. Your background is just phenomenal, right? You and I were chatting a little bit about that earlier, but for our audience that may not know who you are, I'd love to turn it back to you. Why don't you tell us a little bit more about yourself and how you got to where you are today?
Yeah, absolutely. Well, it's kind of an interesting story. It's probably not a whole lot different than most people that, whether they go to college or don't, in your early 20s, you have a idea of what your future looks like. And, when you look back, when you're in your late 30s and 40s, usually it's a much different path. And so my story is not a whole lot different. I went to college and was a college soccer player. Thought my passion was for teaching. And as my kids can attest, I probably would have been a horrible teacher because my husband was the one that helped them with their homework. But, quickly found that I had a niche for lack of better term, sales. I really liked working with clients, regardless of what I was selling, and really found that I had a knack for creating relationships, which I think this industry is so based upon, is really a relationship driven industry. And when my husband and I started having a family, we made the commitment to each other that one of us was going to be home with our children until they were in school. And that was, something that was pretty important to us. And so once my boys were, in school full time, I started to go back into the workforce and had a friend that was in the private money industry, but I had no knowledge of what that actually was. I, was always taught by my parents that when you went to buy a piece of real estate, you went to your banker and you got financing to purchase that piece of real estate, whether it was a primary residence or a investment property. And I was also always taught that when you had money to invest, which was important to start when you were young, you went to your financial advisor or your money manager and you followed their advice, which, I'm not saying is a bad thing, but really was very eye-opening once I went into the private money industry. I started kind of from the bottom. I mean, my friend was a loan officer and he said, well, come be my assistant. And obviously quickly figured out that I wasn't built to be someone's assistant. I had bigger dreams and aspirations. And then kind of migrated, from the origination side of private money into really more of like the escrow, where we helped close the transactions. We also serviced the paper that we originated. So I saw that side of it where you collected the payments, worked with borrowers if they were having challenges, and then ultimately ended up getting my securities license because we sold our paper. We sold mortgage notes. And it was mind blowing. It was like, okay, so you're telling me that if I find a good deal and I want to buy an investment property, there are people out there that want to invest their dollars in this. And if I have dollars, I could even be on the other side of this equation and I can invest my money and most of the time get higher yields on my money than I would typically get in a traditional, mutual funds, bonds, stock market. And it's backed by real estate. Like if these people don't pay, I could take that piece. It was mind blowing. It was like, this is how people create wealth. And so I started working really closely with our investors and quickly realized that these people were everything from, a self-employed entrepreneur to a dentist and doctor that owned their own practices that most of the time had created wealth, along the way, one in their profession, and two through real estate. A lot of them would buy rentals. And I had an individual that owned like 30 rentals. And when he retired, he sold them all. And now he had this massive amount of capital, but they were taking these nest eggs and they were investing in mortgage notes, and they started creating passive cash flow for themselves and never depleting their nest egg. And I was like, I was always taught, you have a nest egg, that's what you live off of. It's like, so you can actually have your money work for you. And then, somewhere down the line, you are passing that generational wealth to your kids. And it just, so, once I realized that, and I have clients currently that I've worked with for 25 years that have invested with me, and now their kids invest with me. And I see the lifestyles they're able to live and provide their families. They're going on vacations as a family. They don't feel a slave to their jobs anymore. They have multiple streams of income. So I just really, it was, that aha moment where it was like, I can change people's lives, and I can change my own life, and I can teach my kids to change their lives and set themselves up financially so that they have generational wealth when they're older. So that's a long story. That was my path to this. And I actually had someone recently on a podcast say, but you are an educator, you're teaching people this. And it was kind of like the light bulb went off. It was like, okay, maybe my path wasn't to teach children, but my path is to educate people. I'm not a financial advisor or a tax professional, but I've been in the industry a long time, and I can tell you war stories and successes. So, here I am today, still continuing to work with our amazing clients, helping them, on their path to financial freedom. I feel like I've been a really good role model for my kids, and they're starting to put some of these strategies in play for themselves. So here I am.
No, I absolutely love that. Absolutely love it. I think it's such an amazing story, and you hit on so many golden nuggets there. And one of them that I was never taught growing up, and I kind of had to learn the hard way, was looking at these two concepts of accumulation and then focusing on cash flow, right? I think as you were speaking, I was just remembering a lot of the things that I've sort of gone through to figure all of that out. And that's just one of the most valuable lessons that I think I've ever learned in life. It is just so powerful, and it forces you to change your paradigm of thinking and everything you've been taught. So that's absolutely incredible. And I'm so happy you brought that up. So you mentioned and talked a little bit about your overall story, right? And how you got to where you are, maybe starting off as a secretary. You had conversations with your husband about somebody being home while the kids are growing up. What was that leap like for you, right? Maybe leaving a stable job and entering entrepreneurship was,
Yeah.
a lot of people are always maybe thinking about that leap, right? And how to properly make that leap. What was that process like for you?
Well, it kind of came out of nowhere, to be really transparent. And it was, even though we were doing well, my husband and I had this plan. At that time, he was running 3 indoor soccer centers, and our goal and our agreement with the owner was that we were buying them. And out of left field, as this is a very common story with business owners and employees that have been there a long time, and there's these side agreements that, oh, when I get out, I'm going to sell it to you. Well, we're not much different. That did not go as planned. And at the time, I was, really just working part-time in the private money industry, getting my feet wet with it. And we found ourselves out of a job. My husband had a 6-figure job. We had just built our dream home in 2007, and we all know what happened in 2008. And we discovered ourselves in a financial situation where, thank God we had planned and we had money set aside, but we couldn't sell our house because it wasn't worth what we had bought it and built it for. We didn't have a 6-figure job anymore. And I quickly decided at that time I was going to get my securities license, and I was going to make I was going full time and I was jumping in with both feet, and I saw the opportunity in this career, in this industry. And so it was almost a forced decision. At that time, we had really thought we would be business owners. We were going to, run with the indoor soccer center, which is a great industry and a business. But that was our path. And someone above us had a different plan. But honestly, looking back, it was the best thing that ever happened to us. And at that time, we both decided we weren't going to leave our destiny in anybody else's hand. It's fine to have a profession and a career, but you got to have a backup plan. Here's a perfect example. Our son is 24, just got hired full-time as a fireman, which is a great career path. But like we've told him, have a side hustle. If you get hurt and you can't work anymore, what are you going to do? And so we decided at that time we were going to get active in real estate. Not only, my passion to work with clients and help them create wealth, but we were going to start to create wealth for ourselves outside of our 8-to-5 jobs. Nobody has 8-to-5 jobs anymore, but outside of our regular income, and we were going to start to buy rentals. We fixed and flipped. We're growing our rental portfolio now. But I wasn't going to be in that situation where I relied on somebody else. And, when that shifted and that plan didn't go as we thought it would, we were, we could have been in big trouble. And so at that point, we decided to really focus on the real estate side of our portfolio and our investments and, creating this, really this legacy to support our lifestyle and to leave our kids, somewhere down the road. So that was a big shift for us.
Yeah. Wow. That is such a powerful story, and kind of contrary to what we're maybe thought, right? We're kind of told get these stable jobs with these amazing benefits. And that's just a story that everybody keeps telling their children, and the children tell their children. And conversations that I used to have when I graduated from college back in 2019 with a lot of my friends, right? A lot of them went off and joined these big tech companies out in California, right? And we've kind of been seeing how that's been playing out the last couple of weeks. A lot of them went up and worked at banks in New York. A bunch of my friends just got laid off from Goldman Sachs, right? So we kind of see the importance of having a plan B, right? Maybe starting a side hustle, because that stable job that we all talk about sometimes isn't as stable as it's made out to be.
Well, and you don't really have control over it, right? You think, and we're taught, go to college, get these high-paying jobs with these big corporations, but they're businesses. And our CEO talks about it all the time. Businesses run on money. Either you make more money to support your expenses or you reduce your expenses. That's the reality of it. And we talk a lot about within our Secured Investment Corp organization is have multiple streams of income. There's nothing wrong with having that job and having benefits. And I think that's really important. But have other streams of income coming in the event that doesn't go as planned, or we're in a crazy market right now. We're in a recession. We've got inflation, so definitely great point. Have other forms of cash flow, whether you need it or not.
Yeah, absolutely. Absolutely. And Heather, I definitely want to give us some time to talk about your specialty, right? And what you do. Right, you're a specialist in real estate funds, you're a specialist in notes. Why don't you tell our listeners a little bit more about how you help individuals?
Sure. Well, I think one of the things that I get asked a lot is, we will talk with new clients and, I want to get into real estate, but I've got a full-time job. I don't have enough capital, so I probably just can't invest in real estate, and I believe that real estate is one of the safest places to put your money, whether that's commercial, residential, self-storage. You have a physical asset backing your investment. And what we tell clients is you don't have to have a large amount of capital. You don't have to deal with tenants and toilets and subcontractors. There are opportunities out there like what we offer where we have essentially built these real estate funds. So we have funds where multiple investors invest their capital. So it's a pool of investors, and operators like us that are seasoned, that have a track record, that have experience, have the ability to manage that fund on behalf of the fund members. And what we do with our funds specifically, again, we focus around residential. So single family up to 4 units those are the asset classes we are in my opinion, the experts at. And we decided a long time ago, we're going to stay in our lane. We're not going to be a fund that's trying to do everything for everybody. You know, I don't want to try to accommodate my guy that likes commercial and my guy that likes self-storage and then my other people that like residential. We focus on residential. And the way that we make our fund members money is we take a portion of the fund and we lend that money out. So if you came to me and said, hey, Heather, I found a deal in Washington, D.C., I'm going to fix and flip it, we potentially would lend you money to go buy that piece of real estate and then lend you money to rehab it. We're going to put a lien against the property. So we are now your lender. Our fund is your lender. And you're going to make me interest payments every month that go into the fund profit pool. And when you get done with the project and you sell it or you refinance us, you're going to pay us all off the principal. If you don't, we've got a lien against your property. So that's how the fund is secured. If you don't make your payments and you default on your note, we're going to foreclose on it. That physical asset comes back to the fund owns it, and then we're going to liquidate the asset. So the fund is well secured. And we do that all around the United States. The other portion of the fund, which is 25%, so 75% is in debt, 25% is held in acquisitions. And we're in a pretty hot market. We're in Spokane, Washington, in a town called Coeur d'Alene, Idaho. We have acquisition specialists that identify properties, and as a fund management team, we decide if we want to buy them. So we'll buy these assets. So again, the fund is well secured. The fund now owns this piece of real estate. Sometimes we fix and flip them. Sometimes we rent them. Regardless of the profit, those profits go back into the fund. And the way you get paid is we pay those earnings out on a monthly basis. So the really nice thing is, you don't have to have $100,000 to go buy a piece of real estate and fix and flip it and deal with a bunch of subcontractors that are flaky. Let us do it. We're the experts at it, but you still get the benefits of it. So you get the profit that the fund generates. We get paid for managing the fund, and then we get an extra kicker if we provide earnings above what we call a preferred rate. There's a 50-50 split. But our clients are earning anywhere from 8 to 10% on our funds. And it's all backed by real estate, and they can actually invest as little as $1,000, which is not common. Real estate funds usually have a pretty high entry level, typically about $100,000. Our fund has $1,000 minimum. Average yields have been around 8%. We do have two funds. One pays closer to 10%, one pays closer to 8%. But really what this provides you is an ability to add real estate to your investment portfolio without any of the headaches. You don't have to deal with it. The other things that is a lot different about our fund than most is our amount of time that you have to stay fully invested, which is called a tie-up period, is only 1 year. Most funds are like 4 and 5 years. You know, you have to stay fully invested. Ours is 12 months. You have to stay invested for 12 months. And then after that 12 months, you can start to divest out of the fund. So again, this is a way for people that are just really passive, that say, I like real estate. I don't really want to go own it myself. I don't want to go try to find the deals. I don't want to lend my money out on my own. I mean, there's tons of horror stories about that. Let us be the professionals. We're the experts at it. The other thing that you mentioned is we do sell notes. So for anybody on the podcast that is active buying notes, or what we call mortgage notes, you're really essentially buying the lien against the property. So those notes that we create within our fund, we also sell that paper. And the reason we do that is then we can just turn our money over and over in the fund, and we can make the people in the fund a little bit higher yield by turning the capital. Some people are a little more risk adverse. You know, you might say, hey, Heather, I'd love to buy a note if it's in my backyard. You know, I'm in Washington, D.C. I'll buy paper there all day long, because you know, and you're sophisticated enough to say, if that guy doesn't pay me, I'm going to foreclose. You know, Secured Investment Corp doesn't lend more than 70% of the value. So I potentially have a 30% equity play in this deal. I might have higher yields in 8 to 10%. But those kind of clients are typically a little more risk adverse. They're saying, I don't necessarily need the monthly cash flow. I'd actually rather acquire that property. If Christian doesn't make his payments, I'm going to take it back. So they're just kind of two different clients. And sometimes they do both. You know, sometimes they have buckets, right? They say, hey, I invest with my self-directed IRA and I want that money always deployed. And then I've got some personal funds that I kind of like to play with the notes side of things. So we can accommodate just about anybody. There's some benefits and there's pros and cons to both, but it's really kind of boils down to like, what's your strategy? What are you trying to accomplish? Is it cash flow? Is it growth? Because with our funds, you can actually reinvest your earnings every month. So now you're compounding your earnings. So any of you on the podcast that are really growth minded, that is a big upside to the funds, is you don't have undeployed capital. That money's just turning in there for you.
Wow, I am fascinated by that. I think that's incredible. Such an interesting model, right? And especially for folks that may be interested in exploring real estate investments, right, and adding that to maybe their portfolio. I think it's a fascinating model. So, Heather, I know we're nearing the end of the interview here. I have two more quick questions from you that are pulled from our listeners.
Okay.
So the first one is, going forward, what do you all have planned in your business and why?
Yeah, I think that's a great question, and it's a common question right now, given the markets. We see opportunity. I don't know that anybody on here has ever heard this, but what do they call a real estate investor in a downturn market? They call them a landlord, right? And in the past, our clients and us, we've done a lot of fixing and flipping. I mean, 2 years ago, it wasn't real hard to make good money on fix and flips, right? You buy a distressed property, you do some improvements to it, and the values were just continuing to increase and increase. That has shifted, right? Now we're in a recession, we've got inflation, interest rates are high. So houses aren't selling quite as quick as they have in the past. And we still see good activity where we're from, but we're a lender nationwide. So what we see really in the future is a lot of opportunity in owning cash flowing rental properties. Real estate investors typically will buy in a downturn market, which we are in. So you're buying at a decrease in the purchase price, even from 6 months ago. I mean, I look on Zillow every day and all you see is price reduction. So you can get some better deals right now. The challenge is selling them, not a lot of people are really active, even though interest rates are relative, right? So you might pay a higher interest rate, but you're buying at a decreased price from a year ago, but consumers don't understand that. So we see opportunity in the future to buy properties, cash flow them probably for the next year. And as interest rates, come down, they're not going back to 3. That is not normal interest rates for anybody on this podcast. But as they level out and people come to terms with the fact that this is normal, you're going to start to see, in my opinion, values increase or at least just level out, and people are going to start to buy again. And then that's when you look at selling those assets, right? But in our area, rents have increased. So the cash flow on these things are incredible. You have to have buying power right now. The challenge is for most investors, they're going to go try to finance it conventional. They're going to pay 6 to 7. They might increase rents, but it may still not pencil out. So we're focusing really around the affordable housing market space. Just for clarification, we don't buy high-end homes. We don't invest in those. They typically are the first area in the real estate market that are affected in, these types of recessionary times. But we really see a good future. We see, we're well positioned as a fund to buy real estate. We're excited about it. We're kind of just sitting, waiting. We think March is going to be a good month to start to buy again. And so again, we're going to stay the course. We're going to continue to focus on the affordable housing market space. So houses under the FHA cap specifically. We're going to continue to buy, probably more focused on cash flowing rentals rather than always just on a fix and flip strategy, because it's just not as profitable as it was right now. And we just, it makes me cringe when people, I listen to the news, the real estate market. It's like, that's what they want you to believe, and that's exactly what people believe. But sophisticated real estate investors get excited about this kind of a market. We think there's big opportunity. So we're going to stay our course. focus on the same types of assets. We've changed our buying box a little bit to adjust, as far as our numbers go. And on the debt side of things, when we're lending money, we're looking at those things too. We have to educate our borrowers. Hey, this might have been a deal 12 months ago. This is not a good deal. Go back, renegotiate your purchase price. You're paying too much for this house. So really focusing when we're talking about the debt is really educating our clients. Like, this is not a good deal. Like, you're putting way too much rehab in this. You're never going to get it out of it. And just making sure that we set them up for success, because when they're successful, our fund makes money. So we want to make sure we're well positioning them that they can exit our loans and make some money.
I love that. I love that. Yeah. Everybody I've ever talked to, right? The downturn is when things go on sale.
Oh,
right.
yeah.
So I absolutely echo that sentiment. If you could give our listeners one piece of advice today, what would it be?
I would give them the advice that they get started investing, and I talk to so many people, well, I don't have enough to start investing. I mean, our fund offers a minimum of $1,000. Like, start somewhere, especially right now for the time of year it is. Everybody's doing their taxes, right? And I have clients all the time, in January, February, oh, I'm paying too much taxes. Okay, did you contribute to your IRA yet? Well, no. Okay, well, why did you not do that? I mean, for 2022, you can put $6,000 a year and you get a tax deduction on it if it's a traditional. Start somewhere. Even if you go put $1,000 in it, get yourself in alignment with a self-directed IRA custodian. This is a way that you can set up IRAs. You can move an old 401k from a previous employer and you can roll it to a self-directed custodian and you can start investing it. You're not going to get dinged. You're not going to get a penalty because you're not taking the money out of your 401k. You're simply rolling it to a new custodian. I quit looking at my 401k because it was too depressing. It is what it is, right? But like my husband is a perfect example. He left an employer a year ago for a new employer, and we moved his 401k over to a self-directed custodian. So instead of losing 20% like mine is doing, he's now self-directing it, putting it in the fund and earning 8% on it. So my piece of advice, that was kind of a long-winded answer, is start investing. Even if it's as little as 1,000. And I guess my second piece would be really educate yourself about how you can start investing through tax deferred strategies like self-directed IRAs. They're so powerful, especially Roth IRAs. If people have the ability to open a Roth, oh my Lord, go do that right now before they get rid of them, because you pay taxes on it going in. But when you're 59 and a half and you've created this massive Roth IRA account, you don't pay taxes on it pulling it out. So educate yourself about self-directed IRAs.
I love how many golden nuggets you've dropped today, because I think it's so powerful. How can our listeners get to know more about you and connect with you?
Sure. So they can always go to our website. So that is Secured Investment, no plural, securedinvestmentcorp.com. We've got a lot of information on there about both of our funds. So again, we have two funds, and then we've got all of our mortgage notes are listed on there. They can actually go into the next page and they can see every mortgage note we're selling. And what I would challenge people to do or encourage people to do is schedule an appointment with me and my team. We're a pretty small team. I mean, our company is large, but my department is 6 of us, and we have a passion for educating people. So you can ask for more information and schedule a 15-minute consultation. There is zero obligation. We'll tell you what we know about self-directed IRAs, give you some referrals for some good custodians out there, and then we can educate them more about notes and also the funds and the pros and cons. It's not for everybody, but we feel like we have enough to offer that we can just about accommodate anybody that's really wanting to add real estate into their investment portfolio with a very small barrier of entry of $1,000.
Awesome. I love that. Heather, once again, thank you so much for hopping on the show. It truly was a pleasure. And I think our listeners are going to get so much out of this show. So thank you so much for all the knowledge you've shared today. And I look forward to catching up soon.
Yeah, thank you also. It was a pleasure.